many investors want to save money. It's not just about making money, right? Now, we know that being a real estate professional gets you a lot of benefits, but what exactly are they? And how do you qualify as a real estate professional? So, joining us today is Darren Anderson, a CPA and tax strategist focused on real estate, to walk through just that. This will be a masterclass on how to leverage the tax code to maximize the money in your pocket and boost your family's financial future. Darren, thanks for joining us.
Thanks, Leo. Okay, I have a presentation here. I'll just go through it and answer questions as they come up.
Let's do it.
So we're talking about how to save tens or even hundreds of thousands of dollars in capital gain taxes as a real estate professional. This is me. I had a 30-year or so career, started at a big CPA firm, went to work for a client for 20 years, ran that company, and then started my own CPA firm in 2019. Our average client saves about $26,000 a year that comes over to us. We really focus on tax planning as opposed to most CPAs. They focus on tax prep, and they do a good job at that, but we focus on tax planning. This is my brother. Interviews new clients, makes sure it's a good fit. And so if you're curious about having us do tax planning for you, you'll probably talk to him. This is our team. We have about 7 employees in addition to myself and my wife. Okay, today's topics. First, I want to explain capital gain tax rates and how they work. And then we'll go into some deferral strategies on capital gains. So first of all, there's 3 types of capital gains. When you sell a property, you have traditional capital gains, which is 15 to 20%, depending on your income tax bracket. You also have Section 1250 recapture. This is limited to 25%, so it's still a preference rate. It's always better than paying ordinary income taxes. And then you have 1245 recapture. So I'll explain each one. The 1245 recapture is taxed at 37% or whatever your income tax bracket is. You pay that on things that you took bonus depreciation on that were where you took upfront accelerated depreciation on items like equipment. For instance, if you wrote off shelving or a sidewalk or other land improvements in a cost seg study, and then you sell your property, you would have Section 1245 recapture. Section 1250 recapture is the gain that's created by just the straight line depreciation. So if you depreciated a building over 27 and a half years and you're halfway into that and half of it's depreciated up, that creates a gain because your basis gets reduced when you record depreciation. That kind of recapture from regular straight line depreciation, that's called Section 1250, and it's limited to 25%. And then the pure capital gain is just at 15 or 20%, depending on your income tax bracket. And that is just from the appreciation. So if you bought a building for $1 million and sold it for $2 million, the $1 million appreciation is taxed at 15 or 20%, depending on your tax bracket.
That's very interesting. So you're saying, Darren, that when you're selling a property, essentially the gain would go into 3 categories, right? So if you could go back to that slide just now.
Yeah.
Let's say you buy a building for $1 million, you sell it for $2 million, right? Maybe you took bonus depreciation for $800,000. So you're saying essentially the $800,000 that would be under the 1245 bucket. That's like almost like ordinary income rates, right? And then the building value, let's say it was like 100,000. I'm just using the mental framework of mobile home parks as an example. So the building value is quite small. So let's say that 100,000 is applied as 25%, and then the remaining, let's say not 1.1 million, right? That would be the 15 to 20% capital gain bucket.
Yeah, that's right. Yeah, you think of it as like the market appreciation part would be at the 15 or 20%. The straight line depreciation would be at 25%, and the bonus depreciation or other accelerated depreciation would be at 37%. So you recapture the depreciation that gave you deductions in the past at either 25% or 37% rates.
Got you. Interesting. So I
Yeah.
guess the benefit for a bonus depreciation, and let me know if
Okay,
you're going to
so
talk about
there's two.
that.
Yeah, I was going to go on just to sort of look at the
Yeah.
capital gains tax bracket. So in this slide here, you can see long-term capital gains. They're taxed at, if your taxable income, this is your taxable income, includes all your income, your capital gain plus your regular ordinary. So if you have a W-2 or a business, you add up all of this kind of income, the capital gain plus your regular recurring income, and your total taxable income. If that is between 96,700 and 600,050, then your capital gain tax rate is 15%. If your overall taxable income is over 600,050, then your capital gain tax rate is 20%. It's a little bit confusing because it's your total income determines your capital gain tax rate. And then if you're right on the edge, if it's the capital gain that puts you over that break, that 600,000, then some of your capital gains at 15, some of it's at 20. And then people are always surprised to find out that if their overall income is below 96,700, their capital gain tax is zero. So a lot of times retired people might be living on, 1, 2, 300,000 a year, but their actual taxable income is much less than that because they're taking money out of brokerage accounts or other things that don't create taxable income. And so like their taxable income is less than this $96,700, and they can keep their capital gains under that and their ordinary income under that level combined, then they never pay any capital gain tax rates. And I'll talk about a strategy later on that helps you get into the lower tax rates. If you're in the 20% rate, you can do an installment sale and spread it out so you're in the 15% rate. If you're already in the 15% rate, you could do an installment sale and spread out the gains to be in the 0% rate. So there's 3 capital gain tax rates, 0, 15, and 20, depending on your income.
And obviously, like rates. If you're, sorry to jump in, but essentially, like if you're let's say you're full-time real estate investor and you have depreciation, that could effectively bump you below the 15% to the 0% rate.
Yeah, that's right. Like in the same year yeah, that's absolutely right. In fact, that happens often with cost seg studies. You take a whole bunch of depreciation that offsets all of your other income. Yeah. Because it's such a big deduction in, year one. You might buy a property that's $1 million. If it's a mobile home park, 800,000 of it might create a first year deduction. So unless your other income is more than 896,000, then you'd be in the 0% capital gain tax rate if you also sold something that year.
Interesting. So just make sure that when you sell something, you want to buy something and do a cost seg, and then you'll offset the capital gains on the sales for now.
Yeah.
And then, time value of money, right? It's just $1 tomorrow is worth less than $1 today.
Yeah. Yeah. I've had an exact situation happen with clients where we really tried to time the sale in the period where they already had a loss going on or a big cost seg deduction going on or some other big deduction going on, and it made a huge difference for them. If you have your capital gain the year after you have a loss, it doesn't do you any good. You have to pay regular, whatever the rates are that would apply. But if you could put your capital gain in the same year when you had a loss or a big depreciation deduction, then you could get into the 0% capital gain tax rate. I've had that exact situation a few times. Okay, now I'm going to go on to a few. So that's how the capital gain tax rates work. Now I'm going to go on to a few deferral strategies. So the first one is 1031 exchange. Okay, so the 1031 exchange allows you to avoid paying those capital gain taxes or defer paying those capital gain taxes until you sell the next property. There's very specific rules about how the 1031 works. it sounds like, it's just a trade or an exchange, but you have a third party intermediary in the middle so that, in sort of substance, you're selling one property, buying the other property. But before you buy the other property, all the cash stays in an escrow account with the exchange intermediary or your escrow company, and you meet certain timelines, and then you get the treatment like this 1031 exchange treatment. Basically, once you sell a property, you have 45 days to identify a new property, and you must document this identification. And then you have 180 days to buy that replacement property. And then under the tax code, if you have an intermediary involved with this, under the tax code, that's treated like a trade, and you don't have to pay any tax on this exchange. Your basis of that first property carries over to the second property, and someday when you sell that second property, you'll have to pay tax. Or you can do another exchange. And then when you sell that third property, you have to pay tax, or you can do another exchange, and so on and so on. Some people do exchanges their whole real estate career. And then, it's an estate planning strategy. Also, if your heirs get a step up in basis. So, you might have a very low basis in this property if you kept doing exchanges all the way through.
So just to take a quick step back, so like a 1031 exchange, it's basically when you have another investment property to replace your current investment property, and then that's sort of like an agreement that the IRS will say that you don't have to pay your capital gains because you're keeping the money in the US economy, you're providing more jobs, so like we'll let you do that. And
Yeah.
basically roll up the snowball.
Yeah.
Gotcha.
Yeah. I couldn't say why, what the motivations of, Congress was exactly, but that's how it works.
Gotcha. And
Yeah.
you touched on something interesting too, the buy, borrow, die strategy. That's something that we hear a lot now. It's like, they like people online, they're saying, oh, wealthy people, they buy, borrow, and die, right? You buy assets, you borrow against them, then die, and then you pass the assets on to your heirs at a stepped up basis. So it's like you could start with a house, roll it on to like a huge real estate portfolio, and then your
Mhm.
heirs are inheriting it effectively with zero tax, right? Because the basis gets
Yeah,
reset.
that's right. Yeah.
Very powerful.
Yeah. Yeah. Then nobody ever pays tax ever on that
Yeah.
scenario.
Yeah.
Okay. So I pretty much touched on this, but the key requirements to defer a gain are you said it, Leo, the replacement property must be like kind real estate. So basically used for business or investment. So you can't like sell an investment property and exchange into a primary residence. That doesn't work. So it has to be investment property for investment property. So like a commercial building that you used for your business for another commercial building, or a rental house, or a short-term rental. It just has to be investment or business real estate.
Mm.
And it's only
And
for
it
real
can't be
estate too.
business.
Yeah. What's
So
that?
so
And
it
it
can't
can't
be
be
business.
right. It
Okay.
can't be a actual business. It has to be real estate.
Got it.
It
Okay.
used 1031 exchanges used to be allowed for many more things. So if somebody's going, wait, I've done a 1031 exchange into other assets besides real estate, it used to be allowed. Cars and other things were eligible, but
It's planes.
now it's just real estate.
Wild
So
West back in the day.
yeah. Okay. So another thing is all the proceeds must get reinvested. So if you sell, just for an example here, say you sell a commercial property for 2.3 million for the purposes of this example, you have to buy a replacement property for 2.3 million. Sometimes people assume that if this $2.3 million property, say it had $1 million of debt on it, and so your net proceeds are about 1.3 million. Sometimes people assume that they only have to reinvest the 1.3 million. That's not how it works. You have to reinvest the 2.3 million. In this example, when you sell your property for 2.3 million that had $1 million of debt, and you buy a new property, you're probably going to have at least $1 million of debt on the new property, because the new property, unless you bring new money into the transaction, Outside of that, you're going to have at least $1 million loan again on the replacement property. So if you're trying to like not have debt or not grow your real estate portfolio, 1031 exchange isn't like the best method for that. But if you want to just take all the money and live on it, the 1031 exchange isn't the best strategy for that, because the money has to be reinvested into a new property.
So how does it work with the loan? So if you have to reinvest every single dollar, then you have to essentially get another loan of equal or greater amounts for
Yeah,
the replacement property.
that's right. Yeah. Yeah. Or bring new cash into the transaction. Yeah. That,
Hmm.
from some other source.
Got it. Okay.
Yeah.
And
And
what's the boot section?
what's that?
What's the boot?
Well, boot is when you receive cash or debt paid down or some other payment on your behalf. So it's anything. Yeah, that's what it is, and that's tax. So say you received, say this was sold for 2.3 million and the replacement property was 2.2 million, and you took $100,000 out of the transaction, that'd be considered boot, and that's just a tax term, and then you'd be taxed on that 100,000 part.
So you're allowed to take out a portion of the proceeds from the original sale as a boot. Just like if you sold for 2.3, you could take off 300K just to, I don't know, have a big party or something.
Well, it would be taxable though. You'd be paying capital gain tax or
Hmm.
depreciation recapture tax,
Right.
whichever the case was on that.
Got it. But you still are allowed to take a boot.
You
On
can
like a
take some
partial.
money. You can do like a partial exchange. So you can defer some of the gain, but not all the gain. So say in this example, this $2.3 million property, say the basis was like 1.3 million on that. And so there's a $1 million gain. Well, if they bought the replacement property and they couldn't find a replacement property that cost the full 2.3, or they didn't want to, they just bought a replacement property that cost $2 million. Then 300,000 of it is taxable and 700,000 of it is deferred. So they would pay just the tax on the 300,000
Hmm, that makes sense.
instead of deferring the whole $1 million gain. They would defer only 700,000 of the gain in that example.
That's good. Yeah,
Yeah.
I think that gives a lot of people more flexibility, right? Because people have lifestyle costs or anything like that. That makes it possible.
Yeah, and it's not pro rata, so I want to caution that it's not pro rata. Um, Say that $2.3 million property only had a $300,000 gain on it. Say you bought it for 2, sold it for 2.3, and ignoring the depreciation effect for a second here. If you replace the property, if you sold it for 2.3 and bought a replacement property 2, you don't get a pro rata. It's not like you get 90% of the gain deferred. It's dollar for dollar from the gain. So in that example, the whole 300,000 would be recognized as taxable gain. Okay, and then any portion of the like kind property that, like, if you sold real estate and then your replacement property was something that was real estate plus some stuff that wasn't real estate, like in this example, things that wouldn't qualify are well, we would make the HVAC system qualify because we just consider that part of the building and everything. But the say if you bought a business that was mostly real estate, like a commercial building, but it also came with a pickup truck or something like that, that part wouldn't qualify for the gain. So you couldn't use that part towards the replacement property. It has to all be like kind real estate.
Got you.
Okay, so just in summary, the benefits of 1031 is it allows you to defer paying the gain till later. It's not a permanent exclusion. It's just a deferral of paying that tax until later. And if you defer, keep buying and selling, you're always deferring into the next one. Then someday you might have a permanent exclusion, because if you If you die with this low basis property, your heirs get to step up in basis. So maybe your basis is only 100,000 on a property that's worth 2.3 million. Your heirs get that property worth 2.3 million at a basis of 2.3 million, whatever the fair market value is on your date of death.
So one question, Darren, is so it seems like the 1031 is quite powerful as a wealth building tool, but are there maybe common scenarios where a 1031 might not make sense?
Yeah, if you need the money to live on, like this is sort of part of your retirement, because with a 1031, you have to reinvest all the proceeds.
Mm-hmm. That makes sense. Also, another mistake I see some people make is they're so fixated on finding a 1031 to purchase that they sometimes purchase a worse off property, and they lose money on the second deal. It's like the property's just not a good property. Maybe the tenants aren't good or something like that. So it's always a consideration that you have to make sure
Mm-hmm.
you're still you have to make sure the deal makes sense regardless of the 1031 before you buy it, right?
Yeah,
That's
that's a
that's where
really
people
good.
get tripped up.
In fact, what I see a lot of times is people want to tie that property up, their replacement property, tie that up before they really commit to selling their first property. Because if you sell the property and then have to go find a replacement property, then you're in exactly that situation just described. But if you make an offer and you get in contract on that first property, you can do that actually before you sell the second property. I
Mm-hmm.
mean, sell the first property. You can tie up the replacement property first.
Yeah. So the 45 days to identify, that's just it's not like you have to start identifying and then you have 45 days. It's you have up to 45 days after the closing to identify. So you can identify a few months beforehand too.
Yeah, that's right. Yeah.
Good to know.
Okay, the next one I wanted to talk about is related to 1031 exchange. So it's a Delaware statutory trust. So sometimes people want to be less active in their day-to-day management of their real estate. So a Delaware statutory trust is a mechanism that allows you to reinvest in something that sort of feels more like a fund or a mutual fund, or it's more passive. So it's when you can use this when you want to transition from direct investment to like syndicated deals or a fund that's managed by another developer. So the other developer, they set up this Delaware statutory trust. The property is owned by that, and then you invest in their Delaware statutory trust, and there's a lot of compliance that goes along with that. But basically, it's a way to invest in a property that's also owned by other people and managed by somebody else.
Hmm. So it's like basically if someone was a passive investor into this syndication, that one sold, and then they're like, well, I need a 1031 into the next one, and for whatever reason that group wasn't able to find someone, they could just do a 1031 into a Delaware statutory trust.
Right. Yeah. Or if you if the taxpayer sold a property and then they wanted to invest in something that was, a fund that owned several mobile home parks or several apartment buildings or something like that, those kind of developers sometimes set up Delaware statutory trust so they can take, more than one investor's investment in a, easy to administer way.
Yeah, that sounds good.
Okay. I also wanted to talk about the home sale exclusion. So this isn't, business and um, investment real estate. Now this is your home. So as many of you know, there's a $250,000 exclusion for single, $500,000 for married filing jointly, exclusion on the gain of your principal residence. And it's pretty straightforward. You must meet a 2 out of 5 year ownership test. So basically you have to, if you move out of your primary residence, this is the biggest thing that I see how people miss this. If you move out of your primary residence, you have 3 years. It's 1,095 days to sell that property. If you wait till after that, you have to pay capital gain tax on this, and then you're going to be back into wanting to do the 1031 exchange or something like that, or you're just going to have to pay the tax. So think about if you have a $500,000 gain on your home and you're in a high tax bracket, and say you're in the 20% capital gain tax bracket. If you sell it within 1,095 days of moving out, you pay no tax. All 500,000 is excluded. But if you sell it the day after that 1,095 days, you'll pay the full capital gain tax on that 500,000. So that'd be $100,000. So it's important not to miss these dates. I've seen this happen a lot of times where people move out of their home, move in with like a new spouse, or move out of their home and leave that home as a rental, and buy a new primary residence. And then 5 years goes by, say, and then they want to move, sell that original home. Well, they've lost the exclusion, so they really should have sold that home. If they're going to sell that home anytime in the sort of near future, you should sell it within 3 years of moving out.
And important note is that this is based on a rolling 365 days, right? It's not like calendar year.
Yeah, that's right. It's not months. It's not. I had a client that missed it by a few days one time, and we were wondering, could we count months? But it was,
Oh no.
no, it was to the day. Yeah.
So how do you prove that you moved out on that day? Do they want to see like a receipt for like a moving company or something?
There's not really any real super bright line test on that, but that's a good question. I mean, if we were within distance of that, we'd probably try to document it pretty hard that the other home was still the primary to make those days work.
Mm-hmm. Got you.
I don't know. I don't think there's any real bright line test on how to measure those days.
And I think just
in the case I was thinking about, that person, their mom moved into the home, and then they bought a new home. And so there was some strict closing dates and stuff that were all well documented. So we couldn't find a way to really.
Yeah. And this is literally how tax planning could save you hundreds of thousands of dollars.
Yeah, that's right. Yeah. That person
document it well.
Yeah, they came to me. They basically became a client the year that they sold that home eventually. So yeah, but if they would have known us before that, we would have planned for that. Okay, the next item I wanted to talk about was installment sale. So the installment sale, a lot of times when people sell a property for a big gain, they're using that money to live on over time or for retirement or something like that. And so if that's the case, the IRS lets you have installment sale treatment under these two circumstances. One is if you actually sell your property on a seller contract, so you're just collecting payments, say they're paying you over 5 or 10 years, you recognize your gain over 5 or 10 years. Say the seller owes you $1 million for buying a property, and they pay $100,000 of principal every year plus interest. You only pay capital gain tax on the $100,000 per year. So in that example, you probably could stay well within the 15% capital gain tax bracket. But if you took that whole gain, all $1 million of gain in the year you sold it, you'd have a lot of that gain up in the 20% capital gain tax bracket. So by having an installment sale, you can have permanent tax savings by getting you down from the 20 to the 15, or maybe the 15 to the 0% capital gain tax brackets. And then you can have the time value of money benefit of the deferral of the gain, especially if you aren't spending that money over time. So that's how it works in just a straight seller contract situation.
So it's almost good to keep it under that 96,000 ballpark.
Yeah.
To just maximize their savings.
Right. Right.
Interesting.
So yeah, we've seen people do that exact thing. You can also, if you don't want the credit risk of the buyer, you can do a structured installment sale where, and I won't explain all the details of this because it'd be a little bit beyond the scope, but you get an insurance company to basically stand in the middle, and you basically put your property in a trust type vehicle. The insurance company sells it to the buyer, and then the insurance company sends you money in an installment like way. So you might get $100,000 a year out of this trust that the insurance company has set up in the middle, and they manage your money. Otherwise, like the $1 million goes in there, and then they manage that, invest it, and then you can take $100,000 a year out, or however you want to structure it. And so you get the benefit of the installment sale rules. That's called a structured installment sale. So you need some third parties in the middle there to make that work.
That's very interesting. Yeah, and I think this section really is helpful because a lot of property owners they're trying to plan for their retirement, and they just don't know what to do. A lot of the times, they'll have properties for a long time. They're like, I don't know, why should I consider seller financing, for example? And like this is one reason.
Yeah.
Another one is a master lease as well. I don't know if you know too much about those.
Yeah. Let's see. How would the master lease tie into the installment sale?
So it's another similar way to receive annuity style payments. So the owner is getting paid in monthly payments, for example, and that would essentially get paid or taxed as regular income, but then you would have the lease for a long enough term where the new purchaser or operator runs it maybe after you pass away, and then you give the property to your heirs at a stepped up basis. And then after you pass away and have that step up basis, then the purchaser executes on the option to purchase. Then your heirs get it at a stepped up basis. You're not worried about incurring capital gains taxes during your lifespan.
Yeah. Yeah, that sounds good too.
So there's multiple ways around this.
Yeah. Yeah. And then you also would enjoy the, instead of, say, if that was an apartment building or something, instead of having all those different tenants to deal with, you just have one master lease, and then whoever you're master leasing to it would release to the other folks.
Yep, exactly.
Okay, let's see if where am I? Okay, I want to talk about cost segregation too. So we kind of touched on cost seg, but most residential real estate is depreciated over 27 and a half years. Commercial is depreciated over 39 years. So if you buy a property, that's a really long time to get those deductions. But most people, what they do is they just put on their depreciation schedule, their tax return, they put building and land. The building's at 27 and a half years, the land's at never gets deducted. And then, but what we do when we do tax planning is we go and look at that building and we say, okay, what's inside there? We can segregate out, instead of having like a 2-line depreciation schedule, it might be like 20 or 100 lines long. And we classify out the components of that building that qualify for the 5, 7, and 15-year lives. And then we can take upfront bonus depreciation on that. So now bonus depreciation is at 100%. That started January 20th, 2025. So if you buy and place in service a property after January 20th, 2025, to the extent you have components of that real estate that are in the 5, 7, and 15-year lives, and your CPA knows where those are, or your cost seg firm knows what those are, then you can take an upfront deduction. In mobile home parks, like Leo's business, sometimes you might get like 80% or more. So a mobile home park costs $1 million, 800,000 of it might have a upfront deduction. That's amazing. That'll, wipe out all of your income. For most people, that'll wipe out all of their income this year and the next couple of years. And you don't pay any ordinary income tax because you have that huge deduction. For like short-term rentals, I usually see it about 20 or 30%. Just did one I'm working on right now for a client that was $1 million a short-term rental they bought, and we found about $300,000 of deductions up front. That's a higher percentage than I usually see, but I'd say it's usually around 15 to, that one was about 30%, but don't get your hopes up on 30%. That one had a lot of components that we could classify as 5, 7, 15 year. They had like patio, a bunch of pool type equipment, some outdoor built-in tables and decking and lots of stuff that qualified in these shorter categories. But I'd say it's usually worth 15 or 20%. So if you buy $1 million short-term rental, you're going to get another maybe $150,000, $200,000 upfront deduction for doing this cost save work. If you buy a mobile home park for $1 million, you probably get another $800,000 upfront deduction for doing this kind of work.
So is your next slide about the benefits? Nice.
Yeah, the major benefits, you just you accelerate your deductions and increase your deductions to the early years. And you do that by using bonus depreciation, or in some cases, Section 179 expensing, which is similar to depreciation.
So I can think of 2 or 3 big benefits of the cost segregation. One, as you say, is the time value of money, because you're paying it back dollar for dollar essentially whenever you sell the property, which might not be for a few years. So you can keep that extra cash in your pocket, invest it, get a higher return. Essentially, it's like a interest-free loan from the government.
It's an interest-free loan from the government. I've said that line 100 times. Yeah.
And the second one is that it can bump you to a lower tax rate. Like what Darren said earlier, right? If you bump below like the 96,000, then you're in a whole different tax bracket. And the last one I'm not sure about is if the depreciation recapture is it dollar for dollar, or is it gotten back in a different tax bracket, or like is there like a 25% maximum or something?
The depreciation recapture that's from bonus depreciation, in the year that you recapture it, it's taxed at whatever your natural tax bracket is. So the tax brackets go from 0 to 37%. You have to make over 600,000 to get in the 37% bracket. Below that, it's 35. Below that, it's 32. Below that, it's 2, 12, and 10. So if in the year when you have depreciation recapture, if your natural tax bracket, say if you make, the big one in the middle is 24%. So if you have depreciation recapture, you have maybe a few $100,000 and your other income is a few $100,000, you might be in the 24% bracket. So the depreciation recapture is taxed at 24% in that example. What you would want to do is, it's always better to get a tax deduction today than tomorrow. But if you're taking a huge, bonus depreciation deduction now, and your taxable income is already at 0, and then someday later when you have recapture, you're naturally in a higher tax bracket, you might not, and if it's just a few years later, you might not want to do that, because you're sort of paying the depreciation recapture tax at a higher tax bracket than what you enjoyed for the deduction. So at the year you take depreciation, cost seg depreciation, you get the deduction at whatever your natural tax bracket is. And the year you sell the property, you have to pay tax on that depreciation recapture. You're recapturing that deduction you already took earlier. And that's also at whatever your natural tax bracket is that year.
Gotcha. And the 179, the section 179 on your slide, Darren, that's a separate law from like the cost segregation, right? Or like a separate ruling. It's like if you purchase a Hummer or like a Mercedes G-Wagon or something, you can write off the cost in like year 1 or something.
Yeah, section 179 applies to that. It applies to equipment. It applies to components of commercial buildings, though, too. If the only thing it doesn't apply to is residential real estate. So that's why I put it in there, because if you have commercial real estate, it does apply to that. So bonus depreciation under the current law in Section 179 apply to a lot of the same things in commercial real estate. But Section 178 also applies to, like you said, for instance, if you buy an SUV, you can write off $30,000 up front, the rest over 5 years. That's the $30,000 is Section 179. You can also use bonus now for that too. A lot of times they're the same sorts of things.
So I guess the one differentiating factor is like if someone for whatever reason doesn't want to do a cost segregation study, they could just do the 179 because that's
No, you still
easier
have to do the cost seg study to see what qualifies. Because if you
to.
just put building and land on your depreciation schedule, none of that is eligible. A 27.5-year residential building is definitely not eligible. 39-year commercial building is not eligible for Section 179. You have to segregate out the different things. So like in that building, say if there was like a loading dock, storage, shelving, these kinds of things would qualify for both 179 and bonus depreciation. And so whichever method you're going to use, and there's some ways to optimize this, by the way. Like one recent example was one of my clients bought a farm and used Section 179 for most of these things because it, applied like to everything from like certain kinds of cattle to certain kinds of equipment and tractors and stuff like that. Section 179 applied to. We optimized that. We used all the Section 179 we could. There's a limit to Section 179. In that year, the limit was 1.1 million. And then what we couldn't use on Section 179, we used bonus depreciation for. And there was a bunch of calculations to figure out how to optimize between bonus and Section 179. That part gets kind of complex.
Good to know, yeah, and that's why you want a seasoned strategist on your side to figure this out, right? That's for your team to figure out.
Yeah, that's right. Yeah,
It's great.
Yeah, too complicated to explain right now in this video. But yeah. Okay, what's next here? Okay, we practice in Washington, so I had this slide in here. Washington has a newly enacted Washington state capital gain tax. Doesn't apply to real estate though. Probably not relevant to many of you on this video. Okay, I wanted to say some things about the implementation steps. All of these things we're talking about, creating big deductions with cost segregation studies and any other way we're creating big deductions, that doesn't, if you are just have a regular job or you're not a real estate professional, that doesn't do you that much good because the losses won't offset your other income, because rental real estate is by definition a passive activity, and Section 469 of the code limits passive activity losses to passive activity income. If you have ordinary income, you can't use passive activity losses to offset your ordinary income. So if you have a big W-2, if you're a doctor and you have a big W-2, this is the example you always hear. You can't go buy a real estate project that has huge cost seg deductions and then offset that income. Unless you do this, unless you're a real estate professional. So maybe if you're that doctor and your husband is in the real estate business, they could qualify as a real estate professional. And in that case, those losses flow. So real estate professionals, they treat real estate losses just like any other business losses, and they can offset your ordinary income. So in that case, you can make your big real estate deductions that were driven by probably a cost seg study offset your other income. In that case, you can offset your W-2 income. But you have to be a real estate professional to do that. So the requirements to be a real estate professional are you have to work more than 750 hours a year in a real property business, or, well, I should say, and you have to work more than your other, if you have another job, you have to work more than your other job. So like I had a recent example where somebody had already worked about 1,000 hours in their regular job, and then they were going to become a real estate professional and do some cost seg studies on these 3 real estate projects they had, but they had to quit that regular job and start they were going to work in the real estate business, but they had to quit that job earlier than they wanted to because they had too many hours into that job, and they needed time left in the year to have enough hours in the real estate job. So they had more hours in the real estate job than they had in the non-real estate job. So you have to have over 750 and more than any other job you did that year. Over 50% of your time has to be in the real estate business.
Yeah, that's why a lot of people in the suburbs, there's the wife that's the real estate agent, and then the husband's a successful guy in like finance or private equity or something like that, right?
Yeah.
So they take the depreciation and apply it there.
Yeah, it's a perfect example. And you want to document that in case you don't have to send in that documentation with your tax return, but if the IRS asks about it, you want to be able to substantiate that you really spent all those hours in the real estate business. Okay, so a few reminders on what we talked about. So on the 1031, you need an intermediary in the middle there. So don't. I've had this happen before. Every tax planner's had this happen where the client comes to you and says, "We sold that property. Can we do a 1031 on it?" After it's closed and done, it's too late. You had to have made all these arrangements ahead of time. The exchange intermediary gets involved. Your escrow company will know about that, or you can just find one with a search. And they have to keep the money in a escrow account and then use that money to buy the new replacement property and so on. And there's some rules and compliance, and you can't do it after the fact. So that's on the 1031. If you want to do a deferred sale, a Delaware statutory trust to get a 1031 exchange treatment into some kind of fund, then you'll have to get an intermediary and a wealth advisor involved in that sets up that DST structure. And then on the cost seg, you might need an engineering type firm to do the cost segregation study, or if it's a sort of more straightforward, simple one like a short-term rental, or your CPA might just do it as regular work. They'll charge you for it, but as the regular work that they do is the easy way that takes a minute for them is to set up a depreciation schedule as land and building. But if they take the time to really understand what's there, they can separate it out into all the different components that qualify for bonus depreciation, and that's well worth doing. Cost seg studies probably range from about $5,000 to $10,000 for from kind of complicated ones. Okay, then so if you want to talk to us about it, you can call my brother Zach, and there's his phone number, and there's his email, or me. There's my email and phone number, and there's a Calendly link, and I'll send that link to Leo. Yeah.
Thanks so much for walking us through this, Darren. And for those of you listening, I will drop the information below. Obviously, as the disclaimer says, this is not financial or professional advice. Talk to him, engage him, and then he'll give you specific advice.
Yeah, it's really true. Don't just take this information and try to apply it to your situation. Talk to your tax planner or talk to us.
Right. So I did have a couple of follow-up questions as you were going through it, actually. So let's say a person is doing some just preparing for tax planning. Like, how far in advance should someone ideally start planning if they know they'll be selling a property or planning for a retirement or anything like that?
Well, I'd answer that two ways. One is if you have this kind of stuff ongoing, you should have a regular recurring meeting with your tax planner. The way we do it with our clients, the only way we do it is we have ongoing tax planning, and we meet with them 4 times a year. But most of our clients are business owners, and so then they also have real estate transactions going on. But that's how I'd say the best way to do it is if you have a regular W-2 job and you don't need a lot of tax planning, but you have this one-time sale happening. Obviously, it just really varies, but it's a matter of months ahead of time. It's not like a week before your sale or something like that.
Gotcha. That's good. And as far as people on their journeys, let's say going from like one rental unit to 10 or more, what changes do people typically want to look to make or sort of have in their?
Well, what I see a lot is people might start with a duplex. They do a 1031 exchange into a fourplex. Then they build up some equity. They do a 1031 exchange into a small apartment building and so on. So, they are able to increase their real estate holdings without paying any tax if they keep doing a 1031 exchange in that scenario.
Gotcha. And how do state taxes affect the estate planning or real estate investing strategies? I mean, especially if you own properties in different states, right? Which is becoming
Yeah.
more popular now.
Yeah. Most states, every state is a little bit different, but most states more or less conform to the federal rules. If you have but some states don't give you the benefit of bonus depreciation and stuff like that. Like, for instance, California doesn't follow the federal on the bonus depreciation, unfortunately. So you just have to check it out sort of state by state.
Got you.
But I would also say that anytime somebody's self-employed and making over about 150,000 of net profit in their self-employed business, whether they have real estate transactions going on or not, they should be doing some regular tax planning, because we didn't talk about any of it here, but this is maybe an answer to like that prior question you had, is what sort of things should people do on their journey? When you have self-employment income or real estate investment income, you need to be doing tax planning if it's significant income.
Makes sense. And might be a more nuanced question, but how do you decide whether to hold a property in like an LLC or an S corp or like a partnership,
Mm-hmm.
or is it just all mostly LLCs?
It's almost all LLCs. I never want my clients to hold an appreciating piece of property inside of an S corp. It's very hard to get the property out of the S corp without paying tax, and you also don't get that step up in basis that I talked about on death. So you don't want appreciating property inside your S corp. So if you're going to own your commercial building that you rent to your business, we have two separate entities. One is the LLC that holds the real estate, and then it rents it to the operating S corp. So you want that business kind of income in the S corp. That's where you pay the lowest tax. But you want the real estate income and the real estate ownership to happen in a separate LLC that's not an S corp. And then as far as whether you hold it just personally or inside of an LLC, it makes no tax difference at all. It's just asset protection. Anytime you're dealing with the public, though, you probably want it in some sort of entity that's going to give you some protection if there's like a slip and fall accident.
Yeah, I think that's so important, right? Especially like also where you form the entity. I know some people they like to form it in like Wyoming or something because it's got like better, I guess like piercing the corporate veil or something like that, right? Or like better corporate transparency.
Yeah, I couldn't really say. I mean, that's more your question for your lawyer. But what I see with Wyoming is they have some special where it's more anonymous. So it's hard to tell who owns the Wyoming LLC compared to other states' LLCs. Most
Makes
states you can
sense.
just look up in the Secretary of State and see who owns that LLC. Apparently, Wyoming makes that hard.
Yeah, makes sense. Well, that's all the questions I had. So again, thank you for all your wisdom, Darren. For those listeners at home, his contact information will be below. Please reach out to him for tax planning questions, and wishing you a prosperous journey ahead.
Yeah, you bet. I should have had this slide on here. Okay, there's those numbers.
Excellent.